Welcome to the Solo Retirement Showdown. Today we'll explore whether self-employed entrepreneurs should maximize their 401k, how to balance Roth and pre-tax contributions, and how to leverage your business structure for major tax advantages. Let's set the stage and then move into an actionable step-by-step plan. First, we will outline why this topic matters for self-employed professionals. Next, we'll reinforce Roth IRA fundamentals. Then, we'll analyze the solo 401k and contrast it with a SEP IRA. After that, we'll map pre-tax versus Roth strategies, cover setup steps, test your knowledge, and end with key takeaways and a call to action. Before we proceed, please note this content is educational only and not financial, tax, or legal advice. You should consult a qualified CPA or fiduciary advisor for guidance tailored to your situation. Additionally, contribution rules and limits change, so verify current year figures with official sources before making decisions. With that in place, let's move into why this strategy can be transformative. Now that we have the disclaimer out of the way, let's talk about why this matters. As a self-employed entrepreneur, especially when you pay yourself via payroll from your corporation, you gain access to higher contribution limits and tax advantage structures. This creates more control over your retirement design and enables tax diversification. With that context, let's lock in the non-negotiable base, the Roth IRA. Moving forward, let's reinforce a core principle. Do not abandon the Roth IRA. Contributions are made with after-tax dollars, and qualified withdrawals in retirement are entirely tax-free. This structure provides a hedge against the risk of higher future tax rates and policy changes. Its simplicity, taxes now, freedom later, makes it a crucial base. It also pairs nicely with business retirement plans, ensuring you build tax diversification rather than concentrating all savings in tax-deferred buckets. With that base secured, we can now scale up with the solo 401k. Next, the solo 401k can be a game-changer for business owners with no full-time employees other than a spouse. It enables two contribution streams, an employee salary deferral and an employer profit-sharing contribution. Together, these can often exceed $60,000 a year, depending on rules and income. You may choose pre-tax for immediate deductions or Roth 401k for future tax-free withdrawals, or combine them for balance. The employer portion is typically pre-tax and based on business profits, while the employee deferral can be Roth or pre-tax. With this in mind, let's position the solo 401k against the SEP IRA to clarify when each shines. Continuing, here is a quick snapshot to anchor the differences. A Roth IRA is funded personally, offers Roth by design, and is simple, serving as the tax-free growth base. A solo 401k combines contributions from you and your business, can include an employee Roth option, and is moderately complex but powerful for maximizing limits and tax flexibility. A SEP IRA is funded entirely by the business, generally does not include a Roth option, and is relatively simple, often used for straightforward, large pre-tax contributions. Now let's compare solo 401k against SEP IRA more directly. On the left, the solo 401k provides employee and employer contributions, often allowing an employee Roth deferral. This gives flexibility to tailor contributions to your income and tax outlook, which can help you maximize annual deferrals and balance tax exposure. On the right, the SEP IRA is employer-only and typically pre-tax. It is simpler to set up and administer, which is appealing for some businesses. However, the absence of a Roth option and the employer-only structure may limit your tax diversification. With the differences clear, let's turn to how to set up a solo 401k if it fits your needs. Moving on, here are the steps to set up a solo 401k. First, confirm you have no full-time employees besides a spouse. Second, compare providers for fees, Roth features, loan options, and platform integrations. Third, adopt the plan documents provided by your chosen custodian. Fourth, open the necessary accounts, which may include separate Roth and traditional 401k subaccounts. Fifth, coordinate with payroll to capture employee deferrals correctly. Sixth, calculate the employer contribution based on your compensation and business profits. Seventh, ensure funding deadlines are met for both deferrals and employer contributions. Finally, keep accurate records, monitor contribution limits, and file any required forms. With setup steps clear, let's visualize the timeline of this process. To bring the process to life, this timeline diagram sequences the major steps. starting with your idea and eligibility check, proceeding to provider selection and plan adoption, then opening accounts, setting up payroll deferrals, calculating employer contributions, meeting funding deadlines, and maintaining ongoing records and compliance. This visual helps you plan lead times and avoid last-minute scrambling. With the process mapped, let's turn to how you decide between pre-tax and Roth contributions. Subsequently, to decide between pre-tax and Roth, use a strategy map anchored in diversification. A common approach is to establish a Roth base, then add pre-tax contributions for immediate tax savings, especially in high-income years. If you expect higher tax rates later, favor Roth to protect future cash flow. Maintain multiple tax buckets, tax-free, tax-deferred, and taxable, to manage your retirement tax brackets and hedge against legislative risk. You can also mix Roth and pre-tax within the year to balance benefits. Finally, remember that a taxable brokerage account supports liquidity and capital gains planning. With the strategy in mind, let's check your understanding. Here's your first question. Who is generally eligible to use a solo 401k? Option A, any W-2 employee at a large company. Option B, business owners with no full-time employees other than a spouse. Option C, only nonprofits with volunteers. Option D, anyone with a brokerage account. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Solo 401ks are designed for business owners with no full-time employees other than a spouse. This allows you to contribute as both employee and employer, unlocking higher annual limits. Second question. If you're in a very high tax bracket this year, which contribution type often delivers the greatest immediate benefit? Option A, Roth contributions for a current year tax deduction. Option B, pre-tax contributions for a current year tax deduction. Option C, Roth contributions for employer profit sharing. Option D, pre-tax contributions for tax-free withdrawals later. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. In very high-income years, pre-tax contributions often deliver the most immediate benefit by reducing your current taxable income. You can still maintain long-term tax diversification by continuing Roth IRA contributions. As we near the wrap-up, here are pro tips using a concise markdown-style list. Prioritize your Roth IRA base, then use a solo 401k to maximize contributions, and consider a taxable brokerage for flexibility. For contribution mix, a sample allocation like 60% pre-tax and 40% Roth may balance current savings and future protection, depending on your situation. A SEP IRA remains a strong option for simple, employer-only, pre-tax contributions. Maintain an audit trail with plan documents, payroll reports, contribution worksheets, and key deadlines. Finally, stress test retirement income using tax-free, tax-deferred, and taxable accounts to manage future brackets. Now, let's distill everything into key points. In summary, keep building your Roth base. Use the solo 401k to combine employee and employer contributions for higher limits. Consider the SEP IRA when simpler, employer-only, pre-tax contributions are preferred. Mix Roth and pre-tax for tax diversification, and align your contributions with both your current bracket and expectations for future tax rates. As we close, let's summarize and issue a call to action. To conclude, the best practice is to secure your Roth base and then leverage the high limits of a solo 401k. Use pre-tax contributions for immediate tax savings when appropriate, and Roth contributions for future tax-free income and policy protection. Remember to verify current year limits and consult a qualified professional. Finally, we'll close with a quick thank you and your next action steps. Thanks for watching. If this was helpful, please like the video, share it with a fellow entrepreneur, and subscribe for more practical, no-fluff guidance. In the comments, share how you are balancing Roth and pre-tax contributions in your plan and what you want covered next. See you in the next video.